Hey guys, I'm Tyler St. Louis with the Alethea Homes Group here at Remax Heritage in the Northland. I'm sitting down with Nate Little of Hallmark Home Mortgage, and he's here to talk to us about some options that buyers might have in the current market. As most of you know, if you're not in the market, you've probably heard that interest rates are a little bit higher than what they've been in the last 5 years. Really, we're finally a little bit above where we were then. We're not down as low as 2.75 anymore. We're sitting around 6.5 at the moment, and we're going to talk about a product that's out there that's with the buyer pool kind of being shifted and shrinking a little bit that might be helpful for some buyers that are still in the market, given that particular sellers are willing to work with them on this product. So the product itself is called a 2-1 buy down. Nate, can you give us just a little overview of a high level overview of what 2-1 buy down actually is?
Yeah, absolutely. Well, thank you for making me a part of this,
Yeah,
and for the opportunity to talk to your clients. So yeah, again, my name's Nate Little. I'm a mortgage advisor with Hallmark Home Mortgage. I work here in the same building with Tyler, and the 2-1 buy down is a great option that can help with savings on your monthly payment as a buyer that would have to be paid for by the seller. But it is a great way to offer savings in this recently, historically anyway, high rate environment to help you get through to when rates are expected to come back down at some point next year. But just to offer you a monthly savings. And so the way that it works is the seller would pay to buy your interest rate down by 2% for the first 12 months.
Okay.
And then 1% for the subsequent 12 months after that.
So that's the second year.
That's correct, yeah.
Okay.
So the discount in total would last for 12 months. It's a deeper discount for the first 12 months, and then it steps up a little bit for the next 12 months, and then after that, it would go to the note payment, just the regular payment based on your interest rate that you lock in based on what current market rates are. So as far as how it works, that monthly difference in that mortgage payment, the difference between, say, if you had an interest rate of 6.5%, and for that first year that would be reduced the 2% to 4.5%, that difference in monthly payment, the total of that discount of those monthly payments for the first 12 months added to the total of the 1% reduction
for the second year.
For the next 12-month period, for the second year, that total would be what the seller pays. It's not like a fee that the seller is paying the lender or anything like that. It is actually funds that are put into a pool of money to put with your monthly payments for that first 2 years for the discount. And the really great benefit of this is that if you decide to refinance, as a lot of people are expected to do next year when rates start coming back down again, you don't lose that money that is in that pool of funds. Any unused portion of that is actually applied toward the principal balance of the loan when you do refinance. So it's not, if you do negotiate this, you're not walking away from any portion of that money that you wouldn't use toward the buy down. It would just decrease your loan amount when you close that refinance.
So it sounds like the seller is taking the difference between the rate they lock in, minusing that 2% for the first 12 months, then the 1% for the second 12 months.
Yep.
And like you said, putting it into, does that sit in escrow, or where does that sit? And then how does it come out if it's not used fully?
It's actually, I believe it's considered prepaid interest. It's put into a fund kind of like an escrow account. It's collected as prepaid interest, and then the lender just applies it toward the payments that you make on a monthly basis. So yes, it is like escrow. It is held in a separate fund, but it is not put into your escrow account that is used to pay your taxes.
Yeah, not the individuals.
That's correct.
No.
Yep.
But the lender or whoever owns the loan does hold those funds.
That is correct.
Separate. Okay,
Yep.
awesome.
Yep, absolutely.
Cool. Awesome. So with that being said, I know that we're currently working on a deal with one of my buyers on the 2-1 buy down. And this individual is an individual that, and one thing you've talked to me about a lot, and I want to make sure I let you guys know as well, is that this is not something you should be going into banking on the fact that you're only going to get a rate that's 2% lower than what you're getting. You need to make sure you're qualified and able to afford the monthly payment at the regular interest rate that you would have, such in case, as much as we believe that we can predict the future and know the future, sometimes things don't work out the way that we are. And if rates were to, whatever reason, something tragic happened to the American economy or something, you need to make sure that you can still pay for that rate, given that possibility, very unlikely, but possibility that rates did not come back down. Because one thing you did allude to that I think is really good, Leo, we got our little mascot over here getting in the way.
It's all right.
One of the things we did allude to a little bit was the ability to refinance. So if rates did happen to go lower than what you have locked in, whether it's the 2% lower in the first year or the 1% it's lower than that in the second year, they can refinance, right?
At any time.
At any time.
Absolutely. And that is a good point. You know, we want to take care of our clients and make sure that we're completely transparent and upfront with our clients, and not put you guys in a position that is not going to be good for you long term. And so this is a great option that offers a lot of savings and can certainly get you over the hump to when rates do start coming back down. But like he said, with that said, a refinance is not a guaranteed thing. You do still have to qualify. You do still have to apply. You still have to have income. The property still has to appraise. So it's important to note that you do still have to qualify. And while this is a great option, it's not something that you should 100% bank on to put yourself in a situation where maybe you've pushed that monthly payment higher than you would otherwise be comfortable, and it's forced you into a bad financial situation. I think that's a great point.
Absolutely.
Yeah, and you mentioned the client that we have right now that we're working together. You know, it's important to partner with a realtor who's going to be upfront with you like that, a realtor who has your best financial interests in mind, but also a realtor who just thinks about everything as they're putting the deal together. You know, to Tyler's credit, when he was negotiating this deal for our mutual client that we have right now, he reached out to me and kind of ran the situation. He not only was able to negotiate this credit to be paid for by the seller, plus a little bit more, and that has something to do with the market, but also run that by me and partner with me ahead of time to make sure that it fit the mold as far as lending was concerned. It's important to note that this is considered a seller contribution, and there are limits to that on programs out there. And what you actually negotiated.
Can we stop there for a second and just go, okay, what is a seller contribution?
Oh, yeah. No, good catch. So a seller contribution is anything that the seller contributes toward the transaction monetarily. So in this case, in most cases, it's going to be money that they put toward the closing costs, which is eligible in any transaction. A seller can contribute funds toward a closing cost, but there are limits to that, and those limits depend on the loan program that you're using. Conventional has a little bit lower limit usually than an FHA loan, which is a government loan. So that's just something to keep in mind, and it's important to make sure that you're working with a great agent like Tyler, who is thinking about those kind of things that the average buyer might not think about, and has resources they can reach out to and say, hey, this is what I'm negotiating. Will this all work?
And to Nate's credit, I mean, he's gassing me up, but I mean, I asked him to do this with me specifically because I knew he'd be able to explain it much better than I could. And in closing, maybe we should talk just real quick on some of those limits. I know last week when I was on the phone with you before we decided to do this, I was going to do it on my own and I was jotting down all my notes, and then I was like, maybe you could just better. So let's start with conventional. You just mentioned that. Conventional loan, minimum down payment typically is 5%.
Correct.
And I know you had mentioned that between 5% and 10%, the amount of seller paid concessions was
3%.
3%
of the purchase price.
Of the purchase price. So the seller
That's
is
the
allowed.
maximum.
The max a seller is able to provide to the buyer in concessions is 3% on a conventional loan when the buyer is putting down 5 to 10%. Is that
That's
correct?
Mm-hmm.
And then if they're putting down more than 10%, what's that go to?
So 10 to 25%, it can be 6% of the purchase price as a maximum. And then anything, if you're putting more than 25% down, would be 9% of the purchase price. In most cases, especially when a buyer is depending on the seller to make those contributions, they're usually putting the minimum amount down. So most of the time, if you're looking at conventional financing and asking for the seller to contribute, it's going to be that 3% maximum.
And that percentage, as you just mentioned, is of the sale price. Okay, right. So it's the total sale price on the contract. Let's jump real quick to a government insured loan. We got FHA, VA, USDA. Do those differ at all between each other, or are they all the same?
I believe they're all the same. I know for sure that on FHA the maximum is 6%.
And that doesn't matter what you're putting down.
That's correct.
Okay, so FHA, no matter whether you're putting the minimum 3.5% or whether you're putting down 20%, the max you'll be able to get in seller paid concessions is 6%.
That's right.
And the reason I'm asking him this, or while we're going over this, is because those seller pays and the difference between the mortgage, interest, and insurance for the first year, if you will, that difference in the 2% is what's going to play a role in how much you can ask the seller for. So again, going back to our current client, who's putting down conventional loan buyer 5% down, he was able, because of the current market, to ask for a little bit more of seller paid concessions. But we probably, when I hoped to get him more, I needed to make sure with Nate that we weren't overdoing our limit, because I knew there was some limit. And so luckily for my client, we were able to capitalize on the maximum amount, the maximum 3%, because he was only putting 5% down on a conventional loan. And so not only is he going to get that 2-1 buy down, he's also going to get some of his closing costs paid for.
That's right, absolutely. And it is important to reiterate that the buy down funds that the seller's contributing are a part of that maximum, that 3% maximum. So you were able to get him a great deal, get him the maximum amount contributed by the seller toward the transaction. The cost of the buy down was a good chunk of that 3%, but there were funds left over on what he was able to negotiate, and that just gets applied toward the other closing costs on the loan, reducing his bottom line of what he would need to bring to close. And so I have the numbers on that.
You want to run through them?
Absolutely. So on this one that we're working together right now, it's a conventional loan. It's a $228,000 purchase price. He's putting 5% down, like you mentioned, which was the minimum on that. The total monthly payment, including taxes and insurance on that, on the note rate, so without factoring in the discount on the buy down, was $1,884. So that includes taxes and insurance on that. For the first year with this buy down, because we were able to discount that interest rate by 2%, the first year payment was $1,597. So that's a difference of $286 and change a month. For the second year, the difference was $146, or the savings each month was $146 a month and change. So that made the total monthly payment $1,737. So if you take the 12 months of the $286 savings a month and the 12 months of the $146 a month savings and added all of that total together, the total amount was $5,188 contributed by the seller. And I think the maximum that we were able to negotiate, I didn't do that math on the 228, it was like $6,200 roughly.
Correct.
So the difference between the $5,188 and that $6,200, he got roughly $1,000 in excess of that contributed toward his bottom line and what he had to bring to closing. So he's getting an awesome deal. He's getting this discounted monthly payment. He's getting $1,000 contributed toward his closing that he doesn't have to bring. And then, when rates do come down next year, I'll be talking to him about refinancing then, so that we can bring that down, and whatever's left of that $5,100 we can apply toward his loan.
Yeah, absolutely. And again, this is a product, this is an option for people that are in the current market. This isn't going to be available for every seller. Is not going to be willing to do this. The market and inventory are still very low. The market's still hot. So while things have quote unquote slowed down a little bit and provided buyers with this opportunity, it's not obviously going to be available with every single house. So keep that in mind as well. The nicest houses that are priced well are still going on full list price with little concessions to none. Again, just an option that's out there if you find the right property and the right sellers. And Nate, thank you so much for sitting down with me today and helping explain some of this.
It's my pleasure. Thanks for including me.
Awesome. If you guys need anything, feel free to reach out. Again, I'm Tyler with Alethea Homes Group. My number is 816-716-6762. Nate, you want to drop your info?
Yeah, again, Nate Little. I'm with Hallmark Home Mortgage, and I'm at 816-551-9278. I should also note my NMLS ID is 1215136. You're also welcome to reach out to me anytime. Please don't hesitate to call if you have questions, even if it's not a loan that we're working on together. I'm always happy to help.
Awesome. Thank you, Nate.